Hello, everybody. Welcome to the first part of our lecture series, where we'll be diving into deep economic concepts. I want to make these videos to help better understand the topics and make studying more engaging. I find that I am a visual learner. This will help me understand the concepts a little bit more, and hopefully it will help you guys out too. So today, let's start with one of the core foundations of the financial system, money. We'll explore what money is and its different forms, and why it's so essential to the economy, especially in historical contexts like the 19th century. Without getting too distracted, what is money? Money is anything that is generally accepted in transactions. But for something to truly function as money, it must serve for four critical purposes. And that is the medium of exchange, a unit of account, a store of value, and a means of deferred payment. What does any of that mean? Let's find that out. So let's start with medium of exchange. This is the most obvious function. Money allows us to buy goods and services. Imagine trying to barter with chickens to buy a house. It's inconvenient and incredibly inefficient. So instead, we use money as a way to exchange value. Secondly, we have the unit of account. And this means that money provides a common measure to determine the value of goods and services. We use it to keep financial records, set prices, and balance books. In the 19th century, gold and silver were often used to price assets and different forms of money that coexisted. For instance, privately issued banknotes were widespread in the United States during this period, but their value was sometimes uncertain. Then we have the store of value. So money must hold value over time, allowing people to save and delay spending until they're ready. But this is where inflation can pose a big problem. For example, after the Revolutionary War, the US issued the Continental Dollar, which I'm sure we're familiar with. It experienced hyperinflation. It lost a lot, if not all, of its value, making it a poor store of value. Finally, we have the means of deferred payment. It is money that must be usable for future payments. When a government issues bonds, for example, they promise to repay that money in the future. A means of deferred payment is a key function of money in financial markets. Let's talk about the different types of money that we went over in class. We have commodity money, and this is the type of money that has intrinsic value. Gold and silver are classic examples. Historically, in the 19th century, gold and silver were often used in the United States and other countries to back this currency. People trusted these metals because they had value outside of being used as money. This money was also called specie. It held value because it was rare. And then we have commodity-backed paper currency, which is, in the 19th century, the US government and private banks issued paper money that was backed by gold or silver. These pieces of paper could be used for exchange to get that value in the gold or silver on demand. However, it posed some risks. What if everybody wanted to redeem their paper money at the same time? The system often couldn't handle it, leading to bank runs, which caused financial instability within an institution. And we'll talk more about all of this as we go on through each video. So lastly, we'll hit fiat money. And this is the type of money that we use today. It has no intrinsic value, but it's valuable because the government says it is. Fiat money isn't backed by a physical commodity, but by the trust in the government that issues it. In the United States, fiat money began to dominate during the 20th century, but particularly after the end of the gold standard in 1971. So in economics, we have different forms of money. Legal tender to be one of them. So let's define that. Legal tender is money that has been declared by the government to be an acceptable means of payment for debts, both public and private. But here's the thing. Not all money we use is legal tender. For example, bank balances, checks, and digital transactions aren't technically legal tender, yet they still function as money because people accept them. In the 19th century, banknotes were issued by private banks, which were widely used, but these weren't always accepted everywhere. Imagine that you're living in New York in the 1850s, and you've got a banknote from the Bank of Ohio. It might be worth less in New York because people don't trust the Ohio banks. This was a huge problem in the US monetary system at the time because money wasn't consistent across the entire country. So during the long 19th century in the US, these different banks printed their own, what they called promissory notes, which were promises to pay the holder a certain amount of gold or silver. But these notes varied in value depending on where you were and which bank issued them. In fact, as you moved further away from the bank that issued the note, the value dropped even further. $1 from the Bank of Ohio might be worth only 85 cents in New York. And this created an inefficient system of trade and made transactions cumbersome. Additionally, floating rate notes, where the interest rate fluctuates, became common in bond markets, making it harder for investors to calculate future returns. This volatility highlighted the need for standardized currency, eventually leading to more stable financial systems, what we have now in the 20th century. So, to recap, we have promissory notes, which were written promises to pay a specific sum to the bearer, often used by banks as money substitutes. Floating rate notes, which were debt instruments where the interest rate is tied to the benchmark and changes over time, depending on market conditions. Treasury notes, short to medium-term debt securities issued by governments. Then we have Federal Reserve notes. Today, these are the official currency of the United States. That is your $5 bill, your $20 bill, and your $50 bill, so on and so forth. But back in the day, each state bank had its own version of paper money, which we found was incredibly inefficient. So now we have the Federal Reserve note. And that will be part 1 of what is money. If you guys like this style, please let me know. And if you have any questions or would like a further deep dive on this topic, please let me know. I will work on the next part, which is the functions of money, and explore how these principles impact economic activity. Remember, money isn't just about cash in your wallet. It's about trust, exchange, and stability. Thank you guys. Have a great day.